should I invest in individual shares since they have more franking credits than ETFs? So this person is speaking specifically in relation to ASX shares or ETFs because we're talking about franking credit. And it's a good question. It's like, so someone's clearly gone and looked at some individual shares and noticed that they have more franking credits, more tax benefits than some ETFs, which might not have the same degree of tax benefits. And I know, Dave, you probably spent more time than me looking around with, Australian ETFs in particular. And I guess it's like, where would this strategy make sense, if ever, to you? Is saying, I want more franking credits, so I'm going to buy CommBank and stuff directly. I don't know what CommBank's franking credits are, as opposed to an ETF.
Yeah, it's an interesting question. I suppose firstly we need to kind of unpack why certain companies or certain shares have more franking credits than others, because that's essentially what's really going on behind the scenes here, and it's maybe not what you might think depending on your level of understanding. So it is true that some shares and their dividends will be 100% franked, while other shares and more commonly Australian ETFs will have dividends that are not 100% franked. More likely if it's an index fund, say like VAS or IOZ or A200 or something like that, the franking level is probably going to be something like 75 or 80% in most years. And so the reason for that is because there are companies inside the portfolio that don't pay fully franked dividends and they don't pass on franking credits. And so that's what ends up having an effect on the overall dividend that the index fund is able to pay, because they're simply passing on whatever they receive during the year, the income and the franking credits. So there's a few reasons why companies themselves won't actually pass on franking credits and why that affects the underlying portfolio. And so sometimes that's because they are companies which earn money overseas, and so they may not actually earn a lot of money in Australia and pay enough tax in Australia to actually be able to pass on franking credits, because most of the earnings may come from overseas sources. So there's not actually any tax credits to pass on. And that's not necessarily a bad thing. It just means that the money's coming from elsewhere. There's not Australian tax that's been paid. Another way that might happen is with something like real estate trust, where they're taxed a bit differently to a company, where a company earns money, pays tax, then it can pay a dividend and then pass on the tax credit, like a franking credit for the tax that they paid. So something like a real estate trust is taxed a bit differently, where for the most part, I believe the ruling is if they pay out the vast majority of their earnings, something like 90% or more, they don't pay tax. And so essentially you'll end up paying tax on those earnings. So the money is passed straight through to you. And although it doesn't come with a franking credit, it means that there's been less tax on the same dollars before they reached you. So more franking is not necessarily better than less franking. It doesn't really work like that. Like franking credit is not just like magic money, right? It comes from tax that a company has paid. So aiming for the most franking credits, I would say, is not really, it kind of misses the point. I wouldn't be buying shares just because one's 100% franked and one is not. So another way you'll see this compared, especially in Australia and with index funds and other options, is with a listed investment company. So you can have a listed investment company, and if they invest in the top 300 companies, just like an index fund would, they'll have to pay tax on some of their earnings because they're a company, whereas an index fund operates as a trust. And so because they pay tax, they'll generate some franking credits. And so that's why you'll see listed investment companies or LICs and their dividends are pretty much always fully franked. It's because they pay tax, whereas index funds do not pay tax. They simply pass on whatever dividends and whatever franking credits they get. And so it basically works out the same, and you're not actually getting more because there's been more tax paid in the first place before that other money got to you. So it might be a bit of a convoluted and tricky way of covering the question, but I hope that kind of explains the difference in tax mechanisms for different products and why they're a bit different and why it's not necessarily better to have more franking credits or whatever the case may be. So I wouldn't necessarily focus there. I would focus on just picking some sensible long-term investments that align with the strategy that you're happy to stick with for a long time, and ideally not succumb to selling and then trying to buy back again at a lower price.